Agoa uncertainty is adding to the poultry sector's woes. Poultry producer Astral Foods highlights the lack of clarity around Agoa and trade concessions with the US as a threat to investment, employment and long-term local industry planning. The act allowing a number of sub-Saharan African products duty-free access to the US expired in September, and while negotiations are underway for Agoa's renewal, Astral Chair Tinus Alof reminds the market that the poultry sector has borne the brunt of concessions made under Agoa before. 72,000 tons of US bone-in chicken imports are allowed into South Africa annually at preferential rates, impacting local production, job and investments in the industry already battling rising input costs, disease risks and weak consumer demand. Owing to South Africa's growing political tensions with the US, the jury is out on whether the country will still be part of Agoa moving forward. Calls are growing louder for Communications and Digital Technologies Minister Soly Malatsi to abandon his latest directive on BEE rules and sector participation. Kusela Sangoni Diko, chair of Parliament's Portfolio Committee overseeing the industry, is the latest to voice her disapproval. Last week, the committee rejected the minister's plans to amend BEE regulations to help international players enter the South African market. Malatsi, in the meantime, has directed ICASA to urgently consider the use of equity equivalent investment programs in the ICT sector. This will allow qualifying multinationals to meet empowerment obligations through alternatives to 30% ownership. Retail property is enjoying a welcome expansion. The third quarter Clear Shopping Centre Index notes annualized year-on-year trading density growth of 5.5% across all shopping centres surveyed during the period. Out of the three major provinces, the Western Cape leads with trading density growth of 6.2%, followed by Gauteng with 5.7% and KZN with 3.8%. This growth outpaces inflation and signals a sustained recovery in consumer-facing assets. South Africa's farm machinery sales are on a steady upward trajectory. Tractor sales rose by nearly a fifth in the first 11 months of this year versus the same period last year. Combined harvester sales, in the meantime, ticked up by 3% year-on-year. That's according to data from the South African Agricultural Machinery Association. The sales rally comes as favorable weather conditions and rate cuts fueled farmer sentiment. Agba's chief agricultural economist, Wandile Sihlobo, says that this data is an early indicator that agricultural machinery sales will be strong in 2025 and continue on this path through 2026. Cement makers are gearing up for a rebound in sales next year. This thanks to early signs of renewed momentum in private sector construction and provisional infrastructure projects. Major contracts awarded by Sunral, Rand Water and Eskom signals that government will push ahead with strategic builds. The value of large projects now sits at over 10 billion rand, representing a jump of 56%. A further 11.8 billion rand has been raised and earmarked for priority public infrastructure projects via Treasury's Infrastructure and Development Finance Bond. Independent economist Rudolf Botha, who tracks the sector, highlights that this mix points to a further recovery of the construction sector activity into 2026.